On May 2nd, 2019, Wall Street watched as something new began cooking. A company selling what some called fake meat had the best public stock launch of the entire year. Shares of Beyond Meat surged 163% on day one as the company's valuation rockets past $10 billion. Bill Gates was backing it. Leonardo DiCaprio was invested. Tyson Foods, one of the world's largest meat producers, put money in. Even McDonald's was loving it. It was the future of food, and investors were euphoric. Fast forward to October 2025. Beyond Meat is crashing on the stock market, slashing its workforce, shutting down its operations in China, and bouncing from one controversy to another. This is the story of one of the most spectacular corporate collapses in modern food industry history. And it's not over yet. To understand how Beyond Meat fell so far and so fast, we need to understand how it got so high in the first place. The company was founded in 2009 by Ethan Brown, a man with no food industry experience, but a big vision. He wanted to create plant-based meat that tastes so good, meat eaters would choose it over real meat. For years, Beyond Meat ran quietly, working to develop products from pea protein and other plant ingredients. Then, in early 2016, they launched their new Beyond Burger through Whole Foods. It was interesting, but still niche, and not yet the meat-killing breakthrough Brown had been aiming for. Then came a financial boost. In October 2016, a company that processes billions of pounds of chicken, beef, and pork every year, called Tyson Foods, announced that they were investing in Beyond Meat. If Tyson saw the future in plant-based protein, maybe everyone else should too. Then the celebrity investors piled in. Bill Gates had already backed them through his investment firm. Then Leonardo DiCaprio joined in October 2017. Kleiner Perkins, the legendary venture capital firm, was on board. This wasn't just a food startup anymore. This was a movement with A-list endorsement. By 2018, Beyond Meat was tripling its manufacturing footprint, and their Missouri factory was expanding, tripling their output. Then, in early 2019, they decided it was time to go public. On May 2nd, 2019, Beyond Meat went public at $25 per share. By the end of the first day, shares closed at $65.75, increasing by a massive 163%. That wasn't just the best initial public offering that year, beating out giants like Uber and Lyft, it was the biggest US launch since the year 2000. CNBC couldn't stop talking about it. CBS News declared it the most successful IPO of the year. A company that sold fake burgers was suddenly worth billions. What made it so perfect was the narrative. In 2019, the popularity of veganism was growing, and now you could eat something that's pretty close to a real burger without directly harming any animals. But even if you didn't want to give up meat entirely, Beyond Meat was still a great option because it could help tackle climate change by using less water and producing fewer emissions than rearing beef. And it could help with your health too. Your doctors told you to cut down on the red meat you love so much? No problem. According to a paper published in Stanford Medicine, Beyond Meat lowers the risk of cardiovascular disorders when compared to real burgers. It was the ultimate feel-good investment. You could make money and save the planet. The growth continued into 2020 and 2021. Then, in February 2021, Beyond Meat announced a global partnership with McDonald's and Yum Brands, the parent company of KFC, Taco Bell, and Pizza Hut. The McPlant burger was coming, and Beyond Meat products would be selling in tens of thousands of restaurants worldwide. This was it, the mainstream breakthrough. Except it wasn't. The first major crack appeared in July 2022, when McDonald's quietly ended the McPlant test in US markets. No fanfare, no press release, they just dropped it. But it wasn't so quiet that Beyond Meat's stock didn't fall. McDonald's never explicitly said why they ended the deal, but industry analysts pointed to the obvious fact that Americans weren't buying it. The McPlant was just the first failure. Beyond Meat had multiple fast food partnerships that went nowhere. Restaurant Business Online published a piece titled "The Fast Food Plant-Based Revolution That Wasn't," and the Daily Mail wrote about the 6 times Beyond Meat failed at fast food, including Dunkin's Beyond Sausage, Tim Hortons' Meatless Range, Pizza Hut's Pepper Phony, KFC's Beyond Fried Chicken Nuggets, and Taco Bell's Carne Asada. The products were in the restaurants, but American customers weren't interested. The problem that Beyond Meat could never solve was price. In 2019, Barron's compared Beyond Meat prices with real beef. The plant-based version was significantly more expensive, despite Beyond Meat battling to make them both cost the same. So imagine you're at McDonald's and you have a choice: a regular burger for $3, or the McPlant at $5. For the 5 to 6% of the US population who are committed vegetarians and vegans, that's fine. But to make it viable, Beyond Meat needed meat eaters to switch. And when the fake costs more than the real thing, customers weren't loving it. But there is another problem: the culture wars and a political mood shift in the US. 7 states, including Florida and Texas, have banned cultivated meat. That's any lab-grown meat made from animal cells, which is different from Beyond Meat's plant-based products and shouldn't really affect them, in theory. But the political rhetoric around these bans has created a broader climate of skepticism toward all meat alternatives. Florida Governor Ron DeSantis called it keeping global elite food out of Florida. To some, plant-based food is too woke, and in parts of the US where cattle farmers make up a powerful lobby, politicians are only too happy to agree. Then there was another issue: the fact that Beyond Meat is ultra-processed. Beyond Meat's products have numerous ingredients and go through extensive processing to achieve their meat-like texture. As consumers became more aware of ultra-processed foods and their potential health impacts, plant-based meats got caught in the crossfire. The company tried to defend itself, publishing reports about the health benefits of plant-based meat, and to prove that ultra-processed doesn't automatically mean unhealthy. But the narrative had shifted, and in the public eyes, processed did mean bad for you. As all this was taking place, the market changed and competition intensified. Impossible Foods came on the scene and was fighting for the same shelf space and restaurant partnerships, while traditional meat companies launched their own plant-based lines. The market became crowded, and Beyond Meat's first-mover advantage evaporated. And that competition was entering a smaller market. The first wave of curious consumers who had tried plant-based meat weren't coming back, and the repeat purchase rate was too small to sustain growth. If that all wasn't bad enough, the company started on a run of controversies. First, in September 2022, Beyond Meat's chief operating officer, Doug Ramsey, was arrested after allegedly biting a man's nose in a parking lot fight after a college football game. The irony of the COO of a company selling plant-based meat taking a bite out of a human wasn't lost on anyone. Ramsey left the company in October 2022. Then, just 2 months later, Bloomberg published an investigation alleging that Beyond Meat's key production facilities in Pennsylvania had serious contamination issues. We're talking unsanitary conditions that lead to mold and listeria. The Los Angeles Times covered the story, and Bloomberg Law added more details. The company defended its food safety credentials, but the damage was done. The loss of McDonald's, the scandals, the health scares, the politics, and the changes to the market all created that kind of perfect storm that can ruin any vegan barbecue. In October 2022, Beyond Meat announced it was cutting 19% of its workforce. Suddenly, the company that was supposed to be revolutionizing food was hemorrhaging money and cutting staff to survive. By 2024, Beyond Meat was in crisis mode. In early 2025, the company announced it was suspending operations in China and cutting another 9% of the workforce, followed by another 6% cut in August. The financial statements told the real story. Beyond Meat had never been profitable, not once. Every quarter showed losses. That's not always bad news for a new business if they're growing, but Beyond Meat's revenue was declining. The stock price, which had peaked above $200 per share in 2019, was trading below $1, penny stock territory. But the real crisis came in October 2025. Beyond Meat announced a debt restructuring plan. The company had taken on convertible debt, bonds that could be converted into stock, and now it needed to restructure. It decided the solution to its problems was a debt for equity swap. Bondholders would get stock instead of cash, which seems like a good idea. Except it wasn't a great deal for existing shareholders, because when you create millions of new shares to give to bondholders, every existing share becomes worth less. The stock crashed 56% in a single day. Reuters published a comprehensive analysis on October 23, 2025, with a title that said it all: Boom to Bust. Beyond Meat struggles to stay relevant. The article documented the complete trajectory from IPO darling to financial disaster. Beyond Meat was finished. And then something weird happened. In late October 2025, Beyond Meat became a meme stock. The company announced expanded distribution at Walmart. That's a positive development, but hardly revolutionary. More importantly, Beyond Meat was added to a meme exchange-traded fund stock, or ETF. This is a tradable bundle of securities like stocks, bonds, or commodities listed on the stock exchange. Retail traders on Reddit and other platforms started buying, and the stock surged nearly 300% in just a few days. At the time of making this video, they'd increased by over 1,000%. But even with the surges, the company is still unstable, with shares trading well under their 2019 all-time high of over $230. The temporary stock price increase hasn't changed their fundamental business problems. Beyond Meat's problems aren't about market sentiment or short sellers. They're about the business itself. So, what went wrong? Well, first off, the product never really tasted as good as real meat. Consumer Reports tested the Beyond Burger and found it was close, but not quite there. Taste tests consistently showed that while plant-based meats were improving, they still didn't fully replicate the experience of eating real meat. For the small percentage of vegetarians and vegans, that's fine. But for the 95% of Americans who eat meat, close enough isn't good enough when you're paying more. And that the price problem never got solved. Price is a massive barrier. When plant-based meat costs 50 to 100% more than conventional meat, most consumers won't switch. Beyond Meat needed to scale up to bring prices down, but they couldn't because prices were too high. A classic catch-22. As of late 2025, Beyond Meat is still running, but its future is uncertain. The debt restructuring bought some time, but it didn't solve the fundamental business problems. The company is still unprofitable, and sales are still declining. Beyond Meat's story is a cautionary tale about hype, timing, and the difference between a good idea and a workable business. The concept of plant-based meat that tastes almost like real meat, is healthier than real meat, and is better for the environment is a good one. But none of that matters if nobody buys the product. Could Beyond Meat turn it around? Theoretically, yes, if they dramatically reduce costs, achieve true price parity with meat, and improve taste to the point where consumers genuinely prefer it. The business could work. But that's a lot of ifs, and time is running out. To find out how another massive company was nearly saved by meme stock after it collapsed, check out this video about the rise and fall of AMC cinemas. And don't forget to like and subscribe.